Hello, and welcome to another episode of Angel Insights, the show that goes deep into the world of early stage investing. I'm your host, Tom Britton, co-founder of SyndicateRoom, and on today's episode, I'm delighted to welcome Alister Esam, a serial entrepreneur turned angel investor who's been quietly building one of the most rigorous, data-driven approaches to early stage investing in the UK that I've ever seen. Now, you may not believe me when I say this, but Alister started life as a pig farmer, before studying and moving on to being an actuary and then an entrepreneur. As an entrepreneur, he founded eShare, a board governance platform that he scaled to over 6 million in turnover before selling. Since that sale, he's become an angel investor and invested into over 20 companies, and has more recently launched Angel 6. This episode, we explore why most angel investors get market size completely wrong, the single biggest reason promising startups fail to raise, and why Alister believes defensibility, not growth, is the true test of founder greatness. Now that's enough from me. Let's welcome Alister to the show. Alister, it's absolutely a pleasure to have you on the show today. Thank you so much for joining us.
Thank you.
I was doing a bit of research before the show, and I came across a quite interesting fact. I believe that your first job was as a pig farmer. Is that correct?
I grew up on a pig farm and worked for my dad all the school holidays until I was about 20.
What do you think are some of the lessons learned from that experience that applied to your later life as an actuary and then an entrepreneur?
Hard work. I was taught how to work hard. We would during the summer, we'd be doing 80-hour weeks. So that was one element to it. It was only when I wrote my book, The Dirty Word, that I realized I looked back and reflected on things that occurred in earlier life. And I was also quite process driven from the start. And the way we used to muck out the pigs, I would always be looking for more efficient ways to do it, quicker ways to do it. And so I kind of made it into my book as an example of iterative process improvement when I wrote The Dirty Word.
I haven't read the book yet, but I will add it to the list. I'm curious, were you paid fair minimum wage working for your dad?
No, it was terrible, really. I think my dad had this attitude that he had to give me all the worst jobs because he didn't want to show favoritism. So I think that's probably why I didn't end up going into farming for a profession, because I hadn't had enough of it by the time I was 20. So yeah, no, I wasn't paid fairly.
I imagine not just the work being hard, but running a business like that is quite difficult to manage because you're so dependent on global affairs, feedstock, the purchasing of the livestock, the markets at which you sell and the prices fluctuating all the time. What did that teach you?
Absolutely stupid business, really, because it was a pig farm. So you buy wheat, essentially, which is food, and you sell pork. And those two things fluctuate in a non-correlated way because the wheat just depends on the harvest, and that's not related to the price of pork. One year we would lose £50,000. The next year we'd make £100,000. And it just struck me that this was not a sensible business to have. And so I left, became an actuary. And actually, because the other thing that happened was in that business, you occasionally get disease and you have to cull your whole stock. That happened to my father. So he actually then just closed it down and set up a business park. And I couldn't believe how much better that was for him because he just got guaranteed income. Yeah.
So you went from a pig farm to a business park owner. Is that still running today?
My sister runs it. My mother's still around, but my sister runs it. Yeah.
Fantastic. So you left the family business and you transitioned to actuary. What drew you into that field?
Well, I was good at maths at university, and that was a kind of well-paid profession. I did want to be a city trader, but in 1991, that wasn't probably the year to get into that industry. I remember getting down to the last two at an interview at UBS, but I didn't get the job. So at that point, I kind of had to take second best. So I became an actuary, and and did that for quite a while. Quite enjoyed it, but knew it wasn't something I wanted to do for the rest of my life. So knew I had to break out of it somehow.
What was the way that you broke out in the end?
Fortunately or unfortunately, I had a mentor within there who left to set up his own business, and he asked me to join him as a sort of junior co-founder in that business. And I had so much time for him. I worked for him for 3 years doing that as his head of sales. And we went from virtually nothing to £6 million turnover within about 18 months.
Incredible. eShare turned out to be quite the success. But when you first got started, what was the driving force behind it?
Effectively, we were looking after pension funds, and I'd been looking after small pension funds when I'd been working at Willis Towers Watson. And then in this new role where I worked, we were actually selling to big pension funds. So I was looking after the biggest pension funds in the country, the big FTSE 100 pension funds. And I couldn't believe how poorly they were run. literally the trustees of these things that are responsible for billions of pounds of other people's money would at that time turn up for a board meeting every quarter. They'd get drunk the night before, they'd sleep through the board meeting, they'd have a lovely lunch, and they just couldn't wait for the actual boring bit to be over. And it was my responsibility to attend those board meetings and make sure they were legal and look after them and make sure they had all the information they needed to make the decisions that they made. And I just thought it was terrible. And I thought if they had access to information, better information, 24/7 rather than every 3 months, and maybe had some interaction with that information, then they could do a better job. So I set up what was at the time a governance portal for board members to be able to access information and to improve the way they govern these things.
eShare turned out to be quite the success. You were there for 14 years before exiting in 2018. I'm curious though, you decided not to take capital. Do you think the business would have grown faster had you taken on capital?
Oh, almost undoubtedly. I've got a reference type for that because our big American competitor who started after us took money and became a lot bigger than us. But I don't think the journey would have been as pleasant. I had a nice time and I might not have made so many mistakes as well if I'd had a few VCs breathing down my neck. But on the other hand, I might not have enjoyed it so much and I had total freedom to run that business how I wanted to. And that's a nice thing to have gone through, I think.
Soon after leaving in 2018, you became an angel investor, which is great. And we'll come on to that. I'm curious how, with what you've just said about having a pleasant experience, how does that desire as an entrepreneur affect how you make angel investments? Are you quite lenient with founders? Are you patient with them? What does it translate to in the angel investing space?
I think I've had a lot of useful experiences over the years running my own business. And I think it leans towards a sympathy. To give you an example, I during the early years of eShare, it's amazing how founders and put their head in the sand when there's an issue. And I had a massive issue. So I had kept my head in the sand and we went on holiday to Sicily one year and I sat there and I woke up about 2 a.m. and decided I really needed to face the honest truth. And I looked at it and I said to my wife, I'm not really sure if we're actually going to make it. I said, I think we might have a real problem here. I went back, closed the office, brought everyone in to work in my front room, reduced all the costs I could, and we just made it through. But because of that experience and experiences like that, I've learned that it's very easy when really bad things are happening to put your head in the sand. And I think from a point of view of the startups I'm invested in, I'm very sympathetic, but sometimes they just need a good shake. And I had an example recently, I won't give you the name of the company, but they came.
I don't think you need to have an actuary background to go through we're not selling much, but if we can get to 6, it'll be good. You're like, yes, if you could get to 20, it'd be even better, but how's that going to happen? Not to poke too much fun, but I've definitely seen some decks like that as well.
Top.
You mentioned giving them a shake. What does a shake look like to an entrepreneur? What is that experience? Is it sitting down, opening their eyes to a situation, working through with them, or how do you approach
I think
the
it
shake?
starts with a blunt, this isn't going to work. That's what you're presenting makes no sense. And a blunt kind of, I can see through this and this is daft. And then it starts with, then it just turns into, can we sit down and have a chat about alternative options and what else we might look at? So I think it's just, I say it's a shake, but it's not a violent, it's just a being blunt really, which I've told you is one of my skills.
That's a good skill to have, I think. Fast forward a few years, so 2018, we talked a little bit about angel investing, but before you wrote that first check, you having come from pig farming, actuary, entrepreneur, leaving a business, what were you expecting angel investing to be like? And actually, if we can go back before that, how did you get into angel investing?
So I actually started angel investing before I sold my business in 2017. And it was basically, my business was pretty profitable, which is unusual. I made it profitable as a SaaS business. We had 50% margin. After all the costs of 50% EBITDA relative to revenue. And so I'd got plenty of money in the EIS investing made it worthwhile. And then someone came to me and said, would you like to invest? They'd pre-revenue. They'd got a good idea. Well, I thought was a good idea, but clearly wasn't a good idea. And I just thought, let's just do it and see where it went. And it's almost the profile of an investment I would never ever make today and would run a mile away from straight away. It's like, I didn't compare it to the other investments. They'd got no revenue. They got no proof what they were going to do was going to work. The product was so complicated and complex to explain. It ticked none of the boxes I would be looking for today. And unfortunately for the founder, it failed.
unfortunate, but as you've come to know, most businesses do end up failing. Look for now, talking through that.
Oh, sorry, do you want me to...
I'll rephrase that. Yeah, that one's not on the list, but I do. You've highlighted what you look for, so I'm trying to go to that. So you say that the business had nothing that you look for now in a company. If you don't mind elaborating a bit on what you are looking for in a business, I'd love to hear that.
I find interesting. I think a lot of angels back ideas, and they back kind of people, and they back the hype that they get around it. And I just don't think that works. So pre-revenue to me is just a gamble. And if I look at the failures I've had, they were all almost all early days. There's been a couple that I thought that shouldn't have happened, but most of them, they were all early days. I was getting carried away with an idea. They were either pre-revenue or had pilots. And there's no proof that, other than you think it's a good idea and they think it's a good idea, there's no proof that anybody's ever going to buy it. And buying it is different to being a good idea. Sometimes there are barriers to purchase that you haven't thought about that don't mean it's not a good idea. So pre-revenue I don't do unless I get very excited about that kind of thing, and might do a small investment very occasionally. But so post-revenue, because you've got proof that it's happening, and I can see that they've got proof it's happening, but they just need help scaling and they need funding to scale. And so it tends to be things less than 7 million valuation, probably more than 2 million valuation, with revenue of between 100 and 300,000 or 400,000 a year, and a large market to go for, significant growth. Love it when people come along and they've gone from nothing to 150K ARR in 6 months. So growth, it's all metrics for me. And I think it goes back to me being an actuary as well. That's
most angels would probably disagree with that. So we're going to break your doors, and
a great founder with a terrible idea that isn't getting traction is not going to make it work. Whereas a mediocre founder with a great idea will succeed. And that I don't know how you could argue with that. It's unless ideally you want both, but to prove it's a great idea, you need those metrics.
Okay, fair enough. It's not all reliant on the founder, but are there specific traits you're looking for in the founder?
I mean, for me, and I've learned this from experience, the number one is probably trust. Because ultimately, at the end of the day, the way the startup world is structured, there is usually an opportunity if a founder wants to try and rip you off. So I need to make sure there's trust there. And I think the other thing that I look for is an ability to listen, which you can easily assess from a pitch. And people who don't listen, then you're going to struggle if they get into trouble. They're not going to come to people and ask for help. They're going to put on, and this is one of the problems with founders generally, is they often want to pretend everything's okay when it's not okay. And sometimes it's better to tell your investors it's not okay. Can you help? And then there's another thing I think I look for in founders, which is often a two-person thing, which is just nice if I can get it, which is you've got one's a clear salesperson and one's a clear understands the tech. Those two together make a good marriage. If you've got two founders and they don't have the sales and they're hiring an outsourced product development, it can often, that's quite a big negative for me.
Yeah, it's such a good one. You've invested in over 30 companies now, and you have a mix of involvement with companies, as you would expect with a portfolio of that size. Sometimes you take board seat, sometimes you're completely hand off. I'm curious, how do you decide which role you want to take, if you will, whether you need to be active or you should be hands off in one of your investments?
That's a two-way thing with me. And then for me, I'd only get involved if I can add value, which often means that I tend to get involved in the B2B SaaS or things where B2B SaaS can help them. So for example, I normally do technology, but there was one startup I invested in that was a furniture as a service business, and the metrics were so good. I thought, oh, this is great. And they are doing amazingly well. A company called Homebound. And they're absolutely nailing it. But I invested in them because I just thought furniture as a service is, you're coming from a furniture background and you're doing a recurring revenue business. And it's happening, it's helpful now because they err towards wanting one-off revenue. And I'm like, no, the money's in the recurring stuff. And you want to look like a SaaS company and you'll get better valuations. And so I can add value to that. The other thing is, and it comes out during the pitch process, which is they've got to think that I can add value. So when someone does I did a pitch last night, brilliant business. I think I might invest, but I can't help them. I'm just money. Whereas sometimes you do it and you think, oh, I can see all the things you're doing right. I can see all the things you're doing wrong. And I say that, and if they listen and they take it on board and they show an interest and they ask me to follow up with them, then I think, I'm obviously willing to help.
I'm wondering if you have any metrics on the success rates of the companies that you've helped versus the ones off with.
I don't have any metrics on that, but I think with the sort of 30 odd investments, it's hard to really judge that. No, I've never looked at that.
You touched on it a little bit earlier with your first investment not going so well. I'm curious, how has your investing philosophy changed over the time now that you've got a decent sized portfolio?
I think it's moved from what I think the average angel investor does, which is get excited by an idea and doesn't worry about traction, to wanting to see those metrics and wanting to see traction and that being fundamental. I love it. I like the idea. If I love the idea and I think the idea can change the world and all those things are really nice, but it has to tick those boxes of large market, sensible valuation, significant traction and good growth.
Do you think that you're doing more due diligence now than you did at the start, or is it just different due diligence?
No, I think it's different due diligence. I think the largest thing is people talk about deal flow, but as the amount in that range that I'm looking at, I get enough deal flow that I can cope. I don't want any more really, because I spend enough time looking at decks already in my day. I narrow it down systematically on my PA narrows it down systematically to exclude the high valuations of pre-revenues. And then I'm looking at maybe a handful a week of startups. And I only want 6 a year really at the moment to invest in. So the due diligence often is about, I think the big advantage of looking at enough decks is you can compare. And so if I can look at sort of 200 decks a year and pick 6, I'm pretty sure I've picked the 6 good ones, because you've got enough volume to see what's good and what's bad.
It's good advice. Talking about what you said about what other angels do, I want to just dive into that a bit, because there's often quite the difference between if you ask an angel what they look for, what they care about, and what's actually driving the investment decision. And I'm curious if we can dig into that and start by talking about valuation. We're going to come on to Angel 6, which is your new venture, in a little bit, but looking at valuations for companies, when a founder names a number and they put out, we're going to raise $500,000 on a $4 million pre-money valuation, what's actually going through your head when they say that? Is it, okay, that's the set valuation, that's the right valuation, or is there...
Well, that's kind of like where Angel 6 is. I would take Angel 6 to a place where we have a bit more say on valuation, because at the moment, as someone putting typically 50K into each one of these, and I have been as an individual doing that, and now carrying a little bit more weight. But back then, someone comes to you with that proposal, and you kind of think they've already raised 150 grand. They're not going to drop their valuation for me at 50. But if you get a bit more weight around you, and you can bring a bit more money, then you can negotiate that. So at the moment, what goes through my head really is that's too high, and I'm not interested. And I'll tell them that, but I don't think that they don't very often want to drop it, because they're already getting there. And to be honest, I see people with pre-money 7 million, 10 million valuations passing by me, and I think if you can raise money like that because you've got a great idea and you can get people excited by it, that's fine. Good on you. I can't argue with that, right?
Fair enough. One of the things that founders often inflate is market size. I think you've got a good opinion on this that you shared earlier about having a huge market size isn't much better than just a large market size. I was wondering if you could expand on that.
Decks are ridiculous. That's the first bit. But the second bit is sometimes that's a massive number and people get very excited about it. And again, I think a lot of angels think this is such a big thing, we won't get squeezed out. But I like big. I like having £100 million to go for. But telling me you've got £1 billion isn't a lot better, because £1 billion is just going to attract a lot of interest. You're going to have big US competitors there with deep pockets, and it turns into a knife fight. And you might actually get totally wiped out. And I did have a bad experience with it. I didn't mean to have a bad experience with it. I actually invested in a company that pivoted into becoming an AI software development, AI code. So they actually were, I invested at a 2 million valuation, and they ended up getting a 50 million valuation offer from a VC, because when AI really kicked off, they'd got $500,000 of revenue from helping people do AI code. With hindsight, that's always going to get wiped out, because Claude does that for you now. Copilot does that for you now. Replit does that. Replit does an amazing job of it. And basically, GitHub released GitHub Copilot, and they were wiped out overnight. And they never took the 50 million because he didn't think he needed it.
Enough. You mentioned this company who's helping people with AI code. You're interested in investing.
I don't believe in. I think pilots add value, and I can see why people want people to have pilot projects in place. But for me, I want to see something more than that. Similarly, waiting lists typically for consumer products, consumer software. It's interesting and it has value demonstrating that. But to me, I need to see more. So what I really want to see is revenue, not one client, but a spread of revenue across 10 or more clients. And I want to see that people are enjoying the product and loving it. And there isn't massive churn.
Would you mind sharing a specific example of a company that's had that traction recently?
I invested in something called Your Future, which is this is a little bit of a 9-to-5 area because they are doing recruitment tech, and they're doing blue collar, which is quite unusual for the tech, but they're matching blue collar workers to jobs. And that's something I would be scared about because I looked into mine of the decks I've looked at this year, and I've looked at 10 companies who are doing some form of recruitment tech. But what was interesting about them was they'd gone from 0 to 200,000 ARR. You can't guarantee it's ARR because there isn't any evidence of churn because they've done it all in 6 months. And during the due diligence process, they doubled again. Can't remember the exact numbers, but it's that sort of thing that really gets exciting. And they just look like they were nailing it. So it's risky because it's so short term. It could just be a bubble that they've managed to achieve through good social media and stuff. But they seemed to be doing really well. And those sort of metrics got me excited.
You talked a little bit about quad code and all of these automated tools that have sprung up from everywhere, eating markets. Has that changed your opinion on what traction actually looks like, considering that this business that just mentioned, they've done well, they've got to 200 ARR. Well, there's always a chance that someone built something in the garage, vibe coding that's just as good or better. Do you want to see more traction before you invest now, or quicker movement, or how has it changed your thoughts?
But then, I think like all investors, I also take a look at defensibility, and that doesn't always mean. So there's I suppose several forms of defensibility. There's the clear having a moat. So in that case, they've got some IP which they've produced with universities about profile matching, which gives them some form of moat. And that protects them. But defensibility can also be having a niche that they can fall back on, which doesn't apply in that case. Yeah, I think, and sometimes the defensibility is around the fact that they're doing something in an area that they have great domain knowledge of. And that's a bit like me with the pensions governance. It's a small area. Not many people realize pensions governance was an issue. You haven't got loads of US providers targeting it. There's only a couple of thousand pension funds in the country. And so it was a defensible moat. Anybody could have entered it, but nobody did because nobody realized it was there. And by the time they did, I got it. It dominated it.
I agree with you on that. Transitioning a little bit, you've had great experience angel investing, being an entrepreneur. You've seen a lot of issues in the space, and you've recently launched a business to try and do something about it. So I was hoping, if you don't mind, talking us a little bit.
That's right.
And you've launched Angel 6. Talk me through Angel 6 and the thinking behind it.
So I think you helped me with this, Tom, when I discovered you and you've done the analysis and told me I was doing quite well at angel investing. So my approach seems to work. I think that a lot of people, it's sad because a lot of people do what I did in the early days, which is they get into angel investing, they put £50,000 into something. It doesn't go well because it's pre-revenue. They thought it was a good idea. There's a lot of hype and it didn't work. And then they think, I won't do that again. And it's sad because that's money that UK businesses and UK startups could have that they don't get because generally speaking, those people didn't go through the kind of proper kind of decision-making process as to whether to invest or not. And so I'm looking at loads and loads of investments. I think I'm doing a pretty good job of it. So what I've just decided to do is quite simple really, is to share that with others if they want to invest alongside me. Don't want anything from the investors, so they can just follow me and I do all the work and they get to invest alongside me at no cost. gives me a bit more weight to negotiate better valuations if I can, and get a bit closer to the startups that I invest in and help them a bit more, gives them extra funding. And hopefully, if we can be successful at it, it gives those people that are following me investing alongside great returns. I think it's really interesting because since I started doing it, I think it's improved my decision-making process, because when I'm investing my money, you can often be a little bit, wow, I'll take a chance on that. Or now I've got people following me and I've got to go and turn to them and say, I think this is a good investment, invest alongside me. It's made me spend more time thinking through and ensuring that the investments I make are good investments, because I don't want to let them down. So for me, it's a nice to be straight. If it keeps me, make sure I properly consider the investments and put a bit more time into it.
I'm investing with you. Where should they go? What should they do?
Angel6.co.uk or Alister at angel6.co.uk. There's a chat I can use to get in touch, and then we'll have a chat, and they can follow me if they want to.
How long has Angel 6 been going? Because I know we first spoke maybe a year and a half ago. When did it launch?
Only earlier this year. So we've only just really started collecting followers. So I've got a handful so far. Yeah, I'm not only just putting my own money in, I'm putting a lot more money in. I treat this as a business. I treat this as my job now. And so getting good return on these startups is really important to me.
You highlighted getting more money into the good startups, and the data that we have supports that. So looking at the earlier stages, the success rate of companies that raise, say, a 300K round versus a 500K round, even though there's only only 200,000, but it's £200,000 gap, and you think in the overall VC scheme, that's not a law. There's a significant difference in the success rate of those raising minimum 500 versus those that don't hit that mark.
That's really useful, actually. Because I often get people, we raised enough, should I raise more? And they'll be at a 3 million valuation. They've raised a couple of hundred, and they'll think, well, we'll raise later. Because a lot of people just say more money is better. So that's a really useful statistic to have to prove that.
So you've been great sharing insights and experiences. And I always like to end shows with a few rapid fire questions. And for these, I don't want you to think about them too much. Just the first thing that comes to mind. You ready? Number one, what's the best piece of advice you got as a founder that turned out to be wrong as an investor?
Don't take money.
You would argue, though, that some businesses shouldn't, right?
As an investor, I like companies to take money. As a founder, I didn't want to take money, but yeah.
Fair enough. Question number two, what's the valuation red flag you can spot in the first 5 minutes of a pitch?
Too high relative to valuation, relative to revenue.
Would you rather back a bootstrapped founder at, say, later seed Series A, or a VC-backed founder at Series A? All else equal.
Probably VC-backed.
Would you mind explaining your thinking on that? I know this is rapid fire, but I'm curious. What would you say is the one thing that UK startups specifically consistently underestimate about competing globally?
How hard it is to enter the US market. Yeah. Elaborate. They just don't like foreign things, and they have had startups who successfully done it, and they appear American, and the founders feel like they've got an American nature to them, an American culture.
Would you mind sharing an example of the UK company that has successfully entered the UK? The US. Are there any companies in your portfolio that have entered the US market successfully?
Yeah, a few. One is Nata. They have just done a raise. I invested in about a $3.5 million valuation. They were start. Charlie, who runs it, he's just a really charismatic, confident, bullish person, and he's at heart he's very British, but he looks good in that US culture.
That's a note to all entrepreneurs out there: be more American. What's the best book that you've read recently? It can be business or not business. I might hate reading it, but I will add it to the list. Last question for you. What one piece of advice would you tell a first-time angel investor about to write their first check?
It might be a long time before you get your money back, even if you do. There's a chance you won't, but it might be a long time before you get your money back, even if you do.
No, it's sage advice, definitely. Alister, it's been an absolute pleasure. We've already said it before, but just to repeat it, for anyone that wants to learn more about you and what you do, where should they go?
Go to the website, Angel6, that's just number6.co.uk. There's a contact form there for investors and for startups to get in touch, and startups can upload their deck. Or you can just email me.
Thank you so much. I'd love to revisit this in 12 months' time and then see how you're getting on with Angel 6, what the investments have been like, if your investing philosophy has changed any further. But for now, thank you so much, and we will speak again soon.
Thanks, Tom.
Well, that's it for this episode of Angel Insights, and another huge thank you to Alister for being so generous with his time and sharing his insights. I loved hearing about how he approached market size and what big enough was. If you want to follow Alister's work, search for Angel 6 or Alister Esam. You can find him on LinkedIn. Likewise, you can find me, Tom Britton, on LinkedIn, or if you want to read more about our work at SyndicateRoom, head on over to www.syndicateroom.com. One last favor, if you'd like, subscribe and share this episode. It would mean a lot to us, and I hope to see you listening to the next episode. Have a great day.